everybody. You're kicking it with the Homeboys and the Homeboys podcast, where we talk everything in the world of real estate investing. Whether you're just getting started or a seasoned vet, we're going to give you over 40 years of combined real estate experience to help you on your investing journey. Today, we've got an awesome guest. We are very excited to be here with State Farm agent Ross Whitfield. He has a vast experience in working with real estate investors and just regular homeowners and anyone needing insurance. But today, we are going to talk to him about the world of real estate investing and how people can have the right coverage and be covered in a wild, wild world that we live in today. So without further ado, Ross, how are you, my friend?
I am fantastic, guys. How you guys doing?
We're excited to have you.
Man, thanks for having me.
We've worked with you for a long time, and we've been chilling off camera, just kind of talking and catching up. And man, you're such a cool dude.
I appreciate that.
You're a cool dude.
The feeling's mutual.
So, it's awesome to be here chatting with cool dudes. We're the Homeboys, and having cool dudes on the show kind of goes hand in hand.
There you go.
I don't know why Scott's here.
I thought you said you needed a cool dude.
That's right.
But one of the things that's really interesting about Ross for us is he came to us the old-fashioned way, which is he earned our clients' business with the best rates and some really good service. And Clint and I have been in this industry for a long time. We've seen different people come and go. But Ross came to us by winning over our clients. They would reach out to multiple people, and Ross had the answers for them. And we found that to be repeated time after time. And so he has a proven track record of having some great rates and great service. So I really respect that when someone comes to us that way, because we have a lot of friends out there in this world, especially in insurance.
Right.
And so it's neat when a new person comes in and wins everybody over. So
I really appreciate you guys saying that. And I really do appreciate the business. I enjoy talking to your clients, right? And doing right by them. So, and then really educating them, because sometimes it might be a first-time investor that you guys you begin working with.
Right.
And so taking the time to just go over the policy, and more importantly, this is what you need to be paying attention to. This is what you need to be aware of. Make sure somebody, as you shop me, because I'm assuming you're going to shop me, right? You wouldn't just get one quote and call it a day. But
I think it's very important, when people are shopping, people don't understand that having someone that is well versed in investment property. Not every insurance agent knows, the world of investment property, and we talk about it with insurance agents and mortgage brokers. You don't want to walk into just your big brick and mortar bank and say, hey, I want to buy my investment property. There's specialized people, and it's the same in the insurance world. When people are shopping this, they need to know, hey, you need to talk to someone that knows what they're doing.
Yeah. While I pride myself on, hey, I speak your language, I too invest in properties. So I know what's important to you. I know you're really looking to cash flow this thing. I know what kind of coverage you really need to have. And so I'm going to advise you on what I would do if I were you and I was sitting in your position, knowing what I know.
But it's more than that. We talked a little bit beforehand about your story of how you kind of became a real a specialist and a true expert in insuring rental properties. And it wasn't just that you were an investor yourself. It also happened to be, in some ways, by circumstance, by where your office was.
Yeah, absolutely.
And the way the markets were changing. So I want you to share that with people, how that worked, because I found it very interesting. I think our listeners will too.
Okay, yeah. So my office, if you don't know, and why would you? You've never met me. And so my office is downtown Indianapolis, Indiana. Right. And so a lot of, especially back in 2008, a lot of the property around me was a target for real estate investors. They were buying up a lot of that property, those homes. And so, if you look at, not to get too far into the weeds, you look at where an insurance agent, how he makes his money, it's on premium, right? And so your typical State Farm agency, they're going to make most of their money on insuring autos. That's where our bread and butter lies, right? Being, again, a downtown insurance agent, there aren't a lot of autos, right? Everybody's Ubering, everybody's riding scooters, they're walking to work. That's why you live downtown, because you want to walk to work and that sort of thing. And so for me to find a way to pay the bills and keep my family fed and that kind of stuff, I needed to figure out where am I, what's going on? Where's the business to be had around me? And it really ended up being the real estate investor, all those rental properties that were around my office and in proximity, my zip code, if you will. And so I had to go and learn that business. What's important to that potential client, right?
Right.
What are they looking for? What's important to them? How do I even attract them? How do I approach them? How do I get to them, right? And so I had to dig deep and figure out, okay, well, how's this policy work? What's important to them? Again, like I said, not to be redundant, but what's important to them, right?
Do you think that's why you're so good at this? Our clients, as I told you beforehand, we hear only good about you.
Well,
is it because you speak their language? Is that why?
I think it has a lot to do with it. Even my staff, when I hire on a new staff member, I say, listen, this is our bread. Because really, honestly, that is my major line in my office. It's not the autos. It's not the homeowners. Obviously, that's important to me, and we do write a fair amount of homes and autos, but we really hang our hat. That's what I tell my staff when we bring them on. I say, listen, we hang our hat on the rental dwelling policy. So you got to know this thing inside and out, and you got to understand what's important to this prospect.
I'm really intrigued at how you got into that, because we were living that world, at the same time you were living that world downtown. Like you said, 2008, and all the people that were buying proproperties up in downtown. I was one of them.
Yeah.
Scott was as well at that time. But I also look back on those days with such regret, because some of the prices of those homes down there,
they're giving them away.
Oh, it was crazy.
Oh, man.
I lived on 19th and Central down there, and
what'd you pay for that house?
I paid $40,000.
Yeah,
6,000 square feet.
What did it sell for the last time?
$1 million.
Yeah.
$40,000 he paid.
Yeah, you just want to shoot yourself.
But
woulda, coulda, shoulda.
But the crazy thing at that time is when I paid $40,000 for that, there were 50 on the market at that time, same price.
And you were wringing your hands. Am I paying too much?
Yeah, correct.
Really? I know.
And I look back on there like, oh my gosh. But anyhow, like I know, and I think that's really intriguing about your story is because, man, that's when it was that was the market down there.
It was a fire sale. It was a fire sale. Yeah.
But you make a good point, too, which is you were wringing your hands saying, am I overpaying? We were living in fear because the market was so uncertain that time. It had lost so much that everything was scary. Yeah, if only we had that hindsight.
It's 2020, baby.
That we knew things were going to be okay.
Yeah.
And it's a lesson that I think we carry forward now, which is, markets normalize. They're cyclical. They do go up and down. And if you can stay the course, it's part of what turned us into long-term cash flow investors is it's too stressful. I would just want to buy a cash flowing asset and let it work. Let the tenant pay it off. It'll appreciate over the long term, I'm sure. I don't want to look at the price for over a 5-year period or a 10-year period. I just want that cash flow.
It's funny you mentioned that because after a period of time, right? Because I started my career way back then, as a financial advisor. Right?
Oh, interesting.
Yeah. And so I studied the markets, the financial markets, equities, right?
Yeah.
And the parallel between the stock market and the real estate market is uncanny. 10-year cycles. Right. 10-year cycles. So anyone studies the stock market, there's 10-year cycles. If you just 08 and 18, that there's these bubbles, and everything corrects. They ride up, then they have to correct, everything. It has to correct itself, then it rises back up, then it corrects itself. And so it really is, after being in the business for a period of time, 15 years, I've seen,
You've seen the cycles.
I've seen the cycles, and then I had the experience with regard to being an advisor, investment advisor. And I saw those cycles, and you study those cycles. And you're like, wow, these are amazingly similar.
Yeah.
Yeah.
That's why, and it's so hard to time them. Even the brightest minds in the world can't time them in the market, real estate or the stock market. Well, there's some who can better than others, but
It's funny
Like Bernie Madoff.
yeah. Bernie Madoff. Yeah.
He's a genius.
I know. He gets these returns.
He just gets it.
Yeah. I don't know how
The
he does
market's
it.
lost half its value, but I still getting 18% with my money with him.
Man, on paper, he's this man. He's a wizard. But it's funny you say that because so in the stock market, right? And when to buy, when to sell, that sort of thing. There's a famous adage, which is it's not timing the market, it's time in the market. It's
We
the
say
same thing with
it
real
all the
estate.
time.
Yeah, that's what I'm saying.
Yeah.
The similarities and the parallels between equity investing and real estate investing, they're so similar. It's not even.
I
I think
showed
it's good to
Bryce.
hear you say that.
Yeah.
Because I get so bent out of shape on this show a lot talking about the stock market just because I don't know, it's just not for me. I get emotionally involved and I just feel like I'd make bad decisions.
You do.
You
If you
know,
get,
You do. It's
if you
because
make an
you do.
emotional decision, it's going to be a bad decision.
Yeah, you're selling low and buying high.
So hearing you say that the parallels are there, I'm wondering, is then the big difference in my stupid brain is that it's easier to get out of.
That's
the stock
one of the
market
factors.
because I could click a few clicks of a button on my
That's only
computer.
one
and-
of the factors. The other factors
you
is
know how stupid I am. You can enlighten me.
No. The other factor is
Pray tell.
the other factor is the way you look at it going in. You look at stock saying, I'm going to exit when it's up. That's not how you look at real estate. When you buy real estate, you look at real estate as a hold.
Same with
So-
stock.
You should.
Warren
don't.
Buffett, one of his
He's a value investor.
He's a value style investor, as
Right.
am I. As is the typical real estate investor.
Right.
You're looking for a good deal. You're going to hold it for a long period of time.
Right.
He'll say, "Don't buy a stock unless you intend to hold it for 10 years."
Right. See,
It's like the parallel. I'm a broken record. The parallels are just.
I've become less of a value investor in real estate over my career. I become every year less of a value investor and more of I want it to be a quality asset.
Cash flow.
I almost don't care what I pay for it in a way. As long as I know that that's an awesome property in a good area that's going to have returns, I'm willing to overpay versus something with a little higher risk and unknowns. Now, don't get me wrong. Clint and I, we know how to buy houses and properties very cheap, and it's one of the skills that I'm most proud of that I have. But at the same time, it's the least important part to me. It's literally the least important part. I want good properties in good areas that I trust are going to cash flow. And I have to pay $10,000 more than I want for that property over one that I can get a good value on. All day long, I'll overpay.
Well, let's bring insurance into that. I think that raises an interesting question. So, how is insurance affected by the different areas that you go into? We stay out of typically your low rent, districts. We're not going to go there and see one of Scotty and I's, for rent signs. Up there. We're in more of your suburban family, type, neighborhoods, good schools.
Yes, I've seen your stuff.
Yeah, that's right. That's right. You do all this. So, what's the differences? The analytics that go into that, so people know.
Yeah, and so if you're in an area where there's high crime, high vandalism, high robbery, theft, that sort of thing, and so the insurance underwriters, what we're looking at statistics, right? So we're saying, hey, and within a couple mile radius of this address, how many losses have we seen? And so if you're buying in an area where to your point, if it looks like it's a great deal, right, and that dog might have fleas, right, and it's usually it's a great deal for a reason, right? They're getting rid of it because someone probably buys it.
Sounds too good to be true. Probably is.
Yeah, there you go, bingo, right? And so your insurance premium is good. The insurance company can't say we're not going to insure you, right? That's illegal,
right?
Unless you personally have a poor loss history record, right? You have a ton of claims. Right. However, the premium for that property is going to be reflected in our loss experience in that particular area.
Right.
Right. And so it does. And so you look at it in real estate investor, you're looking at the cash flow. That increased premium is going to eat into your cash flow because you're going to pay more for insurance on that property than you would have had you bought one from the Homeboys somewhere in a nicer area where they have better schools, they have lower crime, they're not going to have as many burglary losses, they're not going to have as many vandalism losses, so on and so forth.
I find this interesting because I've never peeled back the onion to think why this is, but when we see those ghetto property pro formas, their insurance rate is higher sometimes than on a more expensive house. And that makes sense why, probably, right? Because
I always just kind of thought that they were, but they weren't really reflected on those pro formas.
Well, yeah, there's a lot of people
because the
who
people
hide
that are
them. They lie.
that are selling that garbage
lie.
is just putting something bogus on there anyway.
Yeah,
because
but it's fascinating
not real.
that the rates could be less on a nicer house than
Yeah, well, if you look around, you see a lot of vacant homes in that area. That's a problem. So you buy a house, and this happens, and again, because here's from the insurance company standpoint, we don't even like insuring homes that are going to be vacant or they're vacant.
Right.
So if someone comes to me and they say, "Hey, it's vacant," do you intend to have it rented within 30 days? If not, I really don't want to mess with it because there's a high probability someone's going to come in there, break in there, and steal all your copper pipes, right, for scrap.
your AC
right?
condenser outside.
Right.
Yeah, they're going to come and get you, and they're going to file a claim for vandalism.
There's a lot of investors who have run into that before where they'll have a tenant that trashes their property. And,
On the way out the door.
Yeah, and
Yeah.
they may not have a property manager who can turn that quickly. They may be self-managing, and it'll be vacant for 3 months, and they'll get dropped by their insurance.
Yeah, if it's a vacant property, you will get dropped.
Right.
Because we know, again, loss experience.
Right.
State Farm's been around for over 100 years. We know from experience that there's a high probability that your home is going to be vandalized. Someone's going to come in there and steal, the fixtures, right?
Right.
And then go sell them on Facebook
Marketplace.
Yeah, right.
Well, I want to get down to some nitty-gritty questions that I know the people listening want to hear about.
Okay.
So I know that our investors out there that are listening or people who haven't invested who are interested, they want to know how they should insure, what they should insure, high deductible, low deductible, just some of those details, just the bigger picture.
Yeah.
How do you explain what an investor should do with insurance?
Well, typically speaking, the investor, I'll start with, I'm visualizing the policy, right? So coverage A, dwelling.
Okay.
Right? That's the first thing we're really looking at. That's primarily where your premium's coming from. And so just to explain, the way we figure out how much insurance you need it's not dependent upon how much you pay for the property. It's the insurance value. That's what we're looking at. So what's it going to cost us to rebuild this home should a tornado come and knock it off its foundation or it burn to the ground?
Replacement cost.
Replacement cost, exactly. And so, which leads into another point I'll get to in a hot second. But the average the average real estate investor, he or she is, you're in California, you bought a house in Indianapolis. If that house burned to the ground or that house was wiped off its foundation, you're probably not going to go through the hassle of rebuilding that home from scratch.
Correct.
You're going to bury it, take the insurance money, and go buy another one, right? Who's going to try and build a house halfway across the country, right? It's impractical.
Right.
But you might, whatever, but it's not your primary residence, so usually that's not the case.
Right.
And so you probably want to reduce that amount, right? You want to make sure that, hey, listen, if there's a fire or there's a hailstorm, I need a new roof, I got enough coverage for that. If there's a fire and it's partially destroyed, we have ample coverage to make sure that's taken care of. But if the property were to burn to the ground, I'm probably not going to rebuild it because the cost to rebuild is likely more than what you paid for the home.
Right.
Right.
Almost always, right?
Very likely it's going to be more than you. And so you're not going to want to, so, about 80% of that number is probably fine for you, right?
Yeah. So that 80% of that number is generally probably about what the market value of the property is. So you
in that ballpark. It
doesn't have to be exact.
And what you want to do is think about it. What you're doing with your insurance is you're protecting your investment.
Right.
That's really what you're out to accomplish. You're really not out there to build a new home or whatever.
You're not to protect the house. You're protecting your
cash
money
flow
and the cash flow.
Yeah.
And being able to replace it.
Yeah, that's what because again, catastrophic loss, you're going to bury it. You're going to buy something else, right? And start from scratch. You're not going to go through that 9, 10, 12-month process of rebuilding a home.
Right.
And no one wants to do that. And so and as long as we're within 80% of what we call the insurance value, then you're going to have the ability to have a replacement cost loss settlement option. So in the world of insurance, there's two ways your claim will be settled. Either it's actual cash value, which you don't want. Repeat, you do not want. Well, because I'll see people they'll say, "Hey, listen, his quote's a lot less than yours," and I'm like, "Well, send it to me." Right? Because I already know I'm going to analyze them and say, "Well, that's your problem. That's why it's so cheap."
Right. He's
offering you an actual cash value policy. I'm like, what's that? And I'll say, well, I'll paint you a picture. And so, on the actual cash value, let's say you have hail damage to your roof. Now, I'll use real simple numbers to illustrate my point. On an actual cash value settlement, it's a $10,000 roof. You've had the shingles, and usually a roof is a 20-year life, right? 20-year life shingles. You've had it for 10 years. So we're going to depreciate it, because that's what actual cash value is synonymous with the depreciation. So we're going to depreciate it by half, because you've used half its useful life.
Right.
All right. So that $10,000 roof, we're already at $5,000. Now I'm going to take out your deductible, which is $1,000. Let's say you would typical. So here's $4,000 to replace your $10,000 roof.
Right.
Talk to you later.
Right.
Right. That's an actual, and so I don't even offer that policy in my office, because you're not going to remember this conversation I had with you in 10 years when you have that hailstorm. We're in the Midwest, you're going to have a hailstorm, right? And so I want to say, hey, I told you how to get it. A, you don't want to hear that.
Right.
I told you so.
Nobody likes hearing I told you so.
And B, you're not going to remember we had the conversation. So you're going to be mad at me, you're going to be angry at me. And so for me, it's not worth it.
Yeah.
So if someone really is dead set on that's the policy I want to save that extra $100 a year on premium, whatever the case may be, I'm probably not your guy. Right? It's not worth it to me.
It's probably because of somebody as specialized and who really understands the product as well as you talking to so many of our clients. But when there's a hailstorm in the state, we don't get clients calling scared. We get clients calling happy and excited. Hey, did I get hit? Am I getting a new roof?
Am I getting a new roof?
And so it's interesting, the difference between kind of a newbie investor who like hears, oh no, there's a hailstorm that hit my roof, versus the folks that have been in your hands who understand that, hey, you're about to get a new roof if that happens.
So it costs $1,000 for that $10,000 roof, as opposed to $6,000 for that $10,000 roof.
Right.
And that's the difference in making sure you have the right policies. So that's one thing. All right. So that's the type of policy. What else?
And so, so to protect your cash flow and that sort of thing, you always want to make sure that the policy also has what they call loss of rents, because that's a business owner policy. We're protecting your investment. So you had that fire in the kitchen. Right. Let's say they're in their kitchen, they start a fire and they burn down the kitchen. They're leaving. Right. And so now you don't have that cash flow. So loss of rents in your policy is going to protect your cash flow while the other coverages in your policy rebuild, right? Restore that kitchen. And that's another thing I always like to advise the real estate investors to say, you know what you really should think about doing is requiring that your tenant have a renter's policy. And so that scenario I just gave you, they burned down the kitchen. As opposed to you filing a claim on your policy and you have to pay the deductible and your rate's going up because because that's not a weather-related claim. Right. That's a preventable claim, and those make your rate go up. That loss history, right? And so if that tenant has a renter's policy, that is a claim on the liability portion on their policy. So their insurance is covering all that.
Right.
You don't have to worry about it.
And your insurance is the one who will do the work and go after their renter's insurance too. So it's not like you're going to be making calls to their.
Well, you know it. Again, you're going to, on their renter's policy. You're not even going to call me.
Right.
When they burn down your kitchen, you won't even call me because you're going to be listed on their insurance, their renter's policy as additional interest.
Right. And they'll call you.
And so you'll call them and you'll call their insurance company. Right. Or if I'm their insurer, that's fine. Right. And say, hey, this is the loss. This is what happened. Yeah. And they'll deal, and their renter's policy will deal directly with you on paying the cost to restore that kitchen.
Yeah,
and you don't. So you don't even have a deductible in that scenario.
Yeah,
it's liability on their policy.
My daughter's apartment at college flooded on Christmas Day. They were both home.
Pipes burst.
Yeah, and they're in an apartment building, and they're in a building, not like units, like a building. And their unit was next to the main line, the water main line for the building, and it literally flooded their
snorkeling.
everything they had. And renter's insurance was the greatest thing I ever had.
Yeah.
It's just I got a check for I don't know. I think it was $15,000.
Yeah.
To replace all their stuff.
Yeah, and that renter's policy paid for them to go stay somewhere else until they could find another place to stay or get back in their. Yeah. It
paid for mileage because we didn't turn in where they lived. It paid for their mileage to drive from home back to school, where they got mileage instead of a place to live.
Yeah. It blew my mind that his girls had something of value up there, because I told Scott whenever I was in college, you could have wiped out everything I owned. It would have been about $25.
Right.
Yeah, right.
Mine
had a pack of cigarettes.
I would have lost a pack of cigarettes, but the two other things I owned would have been clean because they got water.
That's right. Yeah, it's better off.
No, they would have been an improvement. An improvement. So
that got us going through like our inventory of our college stuff, like the Milk Crate Entertainment Center, and
you had one of those too?
Yeah, that's right.
All blue.
All the
I'm black because I thought that was stylish.
You're such a classy guy.
Kitchen from Goodwill, Salvation Army.
So
while we're talking about that though, when say investors have claims, what does that how does that affect them? Because I think a lot of people think, if I have a claim, then all of a sudden I'm going to be canceled.
No, well, there's claims looked at differently. So if it's a weather-related claim, we don't hold that against you, right? There's nothing you can do about the hailstorm. You couldn't have prevented that. Go back again to the fire. That likely could have been prevented if your electrical system had been maintained and up to, your wires didn't spark and all that kind of stuff. Because typically, if you're going to have a fire, it's either someone in the kitchen who can't cook, right? Or you had faulty wiring in the home.
Okay.
Yeah,
makes sense.
So your electrical panel,
you would know those stats better than me, but that makes sense.
Yeah, but those are typically, if you want to have a fire, that's usually the source is either someone cooking or bad wiring.
Okay, and so those kinds of things will affect the rate more than weather-related claims.
Yeah, and if you have a couple of those type of claims in, let's say, 5-10 years, you're probably going to get dropped.
Yeah.
Because we're assuming it's going to happen again. Because we work on, again, stats law of averages, right? So we're assuming you're going to have a claim every 15 to 20 years. We assume that's going to happen, right? And so once you become an outlier, we're like, the probability of you having another one is pretty good. So we're going to cut our losses.
Right.
So do they base that on, do they judge someone the same if they have 50 policies versus one policy? Because the person with 50 is more likely to have a claim.
No, good question, actually. It's based on per address.
Okay.
Right. So if we drop that particular policy, when it comes to rental dwelling policies, I should say.
Okay.
And so we're assessing each individual location.
Understood.
And not your entire portfolio.
That's good information to know. I have another specific question.
All right.
And I think I know the answer, but I think that you'll know the answer better than us. It's something that we've done. As we've grown over the years with our inventory, with our holdings, we've increased our deductibles over those years because we can handle those losses to the point where, in some ways, we've even thought about not having insurance at all, other than liability, because you have one house burned down. Your insurance cost for all of our portfolio is the cost of a house per year. So you could almost have you could almost self-insure, quote unquote. What do you say for deductibles? Do you say a different amount for a new investor who has one property, or do you think it should be the same up to a certain threshold? Or do you have any opinion?
No, good question. I think it's the situation's the boss. Right? Yeah. And so each individual is going to be different. What your threshold is, because there's a direct correlation, as you would always
assume. Isn't that your wife's nickname? The situation?
She's the boss.
The situation.
That's a guy from MTV.
Yeah.
He's like,
Jersey Shore.
Yeah. He always pulls his shirt. Show the six pack.
That's a kegger.
Yeah, I tell you what, ratings are going down. That's right. No. Not good.
Oh, man.
But anyhow, the situation is the boss.
Yeah, situation is the boss. And so there's a direct, as you already know, or I would assume, there's a direct correlation between your deductible right? How much risk you're willing to assume versus the premium. The more you assume, the lower your premium, right?
Right.
And so if your portfolio and you can bear a larger deductible, rather, I would strongly recommend raising it. So for me, the minimum is $1,000, right?
Right.
But I have a lot of clients who say, hey, listen, jack mine to $5,000.
Right.
I'm going to go $5,000 or somewhere thereabouts, because they're like, if I have a claim and it's if something happens to this house, right, and it's $4,000, whatever, $5,000, I'm going to pay for it out of pocket. I'm not going to file a claim anyway because I want my rates to go up. Right. I'm going to pay that out of pocket anyway.
Right.
And so that's usually what I say is, hey, listen. When I'm talking, especially the new person, and they're contemplating a higher deductible, I say, well, listen, let's look at it this way. If something happens tomorrow, what can you stand without sweating? Right? What's going to make you going to be all right? Saying I can do about $2,000 or $3,000. Like, all right, well, then let's put it there, right?
Right.
But if this is your first one, you don't really have a lot of reserves, right? You should probably go up to $1,000.
For sure. Yeah. If you're already tight everywhere else, our clients and the people listening to this understand that they're long-term cash flow investors. And if you're that tight, where a bump above your deductible is going to derail you, you better get that deductible as low as you can, because you're on this train for the long haul. You can't let $2,000 derail you. So get the deductible as low as possible. So you
build
don't
up
get
your
derailed.
assets,
correct,
and then in 2, 3, 4, 5 years, going and doing a new assessment. Because I have
agree.
clients. Go ahead.
No, I agree. The assessment is a great point.
I have clients, and we'll reevaluate everything every couple, 2, 3 years. Because what we're going to do this segues into a great point with that dwelling coverage A, right? The building itself. Every year or so, we're going to jack that up for you, because you're not going to think to call me and say, you know what, Ross, inflation's taking place. I should probably, in the cost to rebuild, the cost to repair something is probably going to cost me a little bit more this year than it did last year. Right. So we're automatically going to raise it up for you. And so I'll have clients, and every 2 or 3 years, we're going to go through. We're going to do a wholesale review of all their properties. Some will bring back down, like, you know what, I think we're fine here, and we'll do a new evaluation of that property, bring it back down.
Right.
We'll do evaluation of their deductible levels, and as they relate to their premium.
Right.
And again, it's been a number of years. They've retained some more cash, and so they're more comfortable with the higher deductible. So we'll jack that up. Their rates come down. We'll adjust their coverage amount, and then like, oh, thanks. They feel great, right? They save some money, so now they can continue to accumulate cash flow and assets.
Right.
Yeah. So
well, if you're listening to this and you just heard that, call your insurance agent. Call them up, have them do an assessment of your portfolio, look at the values, look at how much your properties have been increased, decrease that insurance if you need to, increase it if you need to, and do a whole overlook on every property you have. That way, you're insured, you're not overspending, and balance that out. And if you're in Indiana, don't call your insurance agent. Call Ross, and he'll take care of you.
That's right.
I endorse that message.
Well, you're a real estate investor, also, and I know we're getting towards the end of our time here, but real quick, is it primarily you? Is it a family situation where you and your wife tackle it together?
Yeah, my wife and I, we work together in the insurance agency, and we work together on their properties.
You're an amazing
You guys still like one another?
We tolerate each other. Yeah.
Okay. Yeah. All right. Cool.
No,
she tolerates you. You still love her, basically. You're just trying not to annoy her too much.
I'm along for the ride.
Smart man.
Smart man. Well said. But I always find it interesting, because I know like every marriage is different. Like I couldn't see me and my wife being around one another all day, every day, and then out, doing the investment property thing. Your kids drive you in different directions, right?
No, we don't even work in the same environment.
Yeah.
And so when I'm in the office, she's working from home, and when she's in the office, I'm working from home. So we're very rarely in the office at the exact same time. Gotcha. Yeah. So no.
So are you working on the houses together? Are you investors that are in there with paintbrushes in your hands, or okay?
There are certain.
Good. I was getting ready to play marriage counselor, and so you need to get away from that offense because I've seen couples go down that road. And I'm like, oh my god.
No. I don't have time for that.
Yeah.
We have 3 kids. We have 2 businesses. I don't have time, nor do I have the desire. Yeah. But what I do is I understand what it costs, how much time it takes for certain repairs.
Right.
So I understand how much this costs. I understand how long you should be working on this project. You know what I mean? That sort of thing. And then I know who to call for. So I know who to call to do this. I have an HVAC guy. I have a plumber. I have an electrician. You have those guys, and you just
Rolodex is very important.
Yeah.
Very
So
important.
so no, but do I want to roll up my sleeves and get there and do that? Nah.
Yeah. Well, knowing that brings us kind of to our. We like to close with 3 particular questions, and we normally have a lot of real estate investors on this show, and you're a real estate investor, but we also got to know a lot more about insurance today. So we thank you for our conversation. But we're going to dive in to a few real estate related questions because you are an investor.
Yep.
Uh-oh.
Yeah. You ready? So the first question is, what's the best real estate decision you've ever made?
To start.
Love it.
Yeah. To start. Just get in there and do it. The first one, you're going to make some mistakes. You'll learn. And then from there, you'll never be happier.
I love it. All right.
Yeah.
Well, that brings us to the next question.
Okay.
What's the worst real estate decision you've ever made?
I didn't buy a property I should have. Multiple properties I should. It gets back to what we're talking about on the top of our conversation, where I was like, well, there's a bidding war, and I tapped out, and now I'm kicking myself like, man, another 5,000, who cares? At this point, it had appreciated
so
60, 70, 80, 100,
It's so true.
Why was I wringing my hands over $5,000? So that would be it. Quit being so cheap.
It's you. I think you'd be surprised how common that answer is. It's almost everyone's answer is it's not that they regret the properties that they lost money on. They regret the properties that they passed on that they should have gone after, because you learn so much on the ones you lose money on and that go wrong. There's still value
and you
in
can still
that money.
Fix it. Yeah, you
correct.
You're like, it wasn't a great year, but I won't do that again.
Yeah, it's what you missed out on.
There's a the restaurant that's on Geist over here, and for our listeners who don't know, Geist is kind of the most affluent area, here in Indianapolis. And we go in there, me and my wife, we eat at that restaurant. And if you look across the water, there's this house right across there that it's the same thing. I was bidding war. I put an offer on it. And it was like, if I had paid $450,000, I would have gotten that stinking house. And we're talking 12,000 square foot, house.
Yeah.
In a
over
state. There. You're right. And just said, nope, I'm standing firm. Went for
You're not going to get me.
What's interesting? The agent who had that listing was just in our office for Bible study for lunch today.
He was. We have a Bible study in here on Thursdays, and he was that agent.
He neatly knew about it.
I think he knows that I've been kicking myself ever since. That was about 10 years ago. But I'm with you. I look back on that, and I think that's such good advice for our listeners. Is like, man, there are times when being cheap really hurts
it'll hurt you.
Gosh, I look back on some of those. It hurts.
And for cash flow investors that are truly buying for cash flow, the value of the property is just a number on a piece of paper because you're not selling it. It's about the returns you're getting. It's
as long as the cash flows. Right. And it's in a great area, you know what I mean? And it's going to appreciate and all that kind of stuff. But you're not even worried about the appreciation.
Right.
You're worried about how much rent
the cherry on top. It's a cherry on top.
Yeah. How much can I rent this for?
Right. Cash flow, baby.
Yeah.
We're cash flow, baby. So the last question is, what advice do you have for that next generation that's coming up? Maybe hasn't gotten into real estate yet or is just starting to.
Other than start?
Yeah. That can be it.
Yeah. Have reserves, right? Have reserves, and don't be afraid to leverage.
Okay.
Don't be afraid to leverage it a little bit. Yeah. Stand what you can, but don't get over leveraged. But you're going to need to leverage.
It's funny. We preach being real cautious with leverage, but at the same time, when you're getting started, it's almost impossible to not, to not go a little past the line that you would like. You know, it's just be ready to pull that back a little bit, live conservatively, but to get started, I mean, I did that.
I mean, I think
I was the king of over leveraged.
Well, over leveraged. Again, to your point, like I don't recommend being over leveraged, but you know, a mortgage is leverage, right? And so you're going to have to leverage. You know, because I talk to people and they think you have to pay cash to get the property. I'm like,
no,
right. And so that's what I mean. But don't be afraid to leverage. Don't be afraid to take a HELOC on your personal residence to get started.
Right.
That could be a great way to get started.
It's a great
down payment for this investment property.
Right.
Get a HELOC. Use that money as your down payment.
Right.
Get started, then pay it back.
Right.
From the rents. Right.
Or if you've saved up, say, $150,000, don't go buy in one house. Go buy 3.
Yes.
Use that as down payment.
Oh yeah, you have to.
So you have to use leverage to your benefit. Just be cautious and responsible with it.
Yeah.
You're like
Well, you know, because I have a little equation that I do.
Okay.
Yeah, and it's if half of my properties are vacant, can I still float? I'm not going to make any money. Yeah. I'm not going to make any money, but can I still break even, right? And not dip into my own kitty, right?
Yeah.
I'm not going to my savings, to pay the bills.
That's a great little
so that's my little thing. Like, hey, listen, if half these bad boys are vacant at any given time. Which could happen. I surely hope it would not.
Right, but
it could. But
you never know. Stars could align, and it all end up at one
your
time.
investments are still paying for themselves without any of your money, even if they're half done. What a great.
I'm still breaking even, right? And then I'm actually, to your point, I'm doing better than breaking even because the principal on those existing are still coming down.
Sure,
I'm still building equity. Right. So,
Ross, how could our listeners get in touch with you? Where could they find you? Where's the best way to get in touch with you?
Please do. But you can give us a call.
He's the real deal. Call him. You know,
I appreciate that. I really do. I appreciate that, guys. And thanks for having me.
Absolutely,
our pleasure.
It goes without saying. It's been a joy. It's been a treat.
I've
had a blast. I've had a blast, and I appreciate the opportunity. But if you give us a call at the office, it's 317-635-1111. And they can find us online at the whitfieldagency.com. So WHITFIELD. So the whitfieldagency.com.
Well, we really appreciate you having on. We wish you many, many years of success, and we're going to know about it because we're alongside of you, my friend. We're going to.
I've enjoyed the relationship. It really has. It's been a
we're on this train with you. So thanks so much for coming in.
Thanks a lot for having me, guys.
So that's our show. If you made it this far, we'd really appreciate it if you'd leave us a review on Spotify or Apple Podcasts. It really helps us to grow our podcast and reach as many people as we can to help them understand the wild world of real estate investing. You can also find some short form content on TikTok. Our TikTok is at the Homeboys Podcast, where you can learn even more about the power of real estate. Thanks for joining us. Till next time, happy investing.